Hi guys, Max here, and this is your daily market update for yesterday, the 29th of June. We are nearing the end of this month. We're nearing the end of the second quarter. So how did equities perform? Well, they were okay, actually, for the most part. As you can see, there is a fair bit of green around there. In big tech in particular, Facebook, Amazon, Apple, and Microsoft were all up for the day. Semiconductors didn't perform too well, and then quite a lot of the old world industries didn't do brilliantly either. Industrials and real estate were quite poor for the day. Oil prices fell as well, as you can see here under the energy sector. That caused energy stocks to fall, which is very normal and fully expected. On the whole then, the indexes actually didn't move much on their own. The S&P 500 fell by 0.08%, so not even 10 basis points. The Nasdaq rose by 0.2% because big tech did a little bit better, and the Dow Jones rose by 0.3% as well. What is a little bit worrying though is that the Russell 2000, so numbers 1000 through to 3000 of the largest companies in the US, none of the companies you see here, well, they fell on average by 1.1%, and they make up a far more better index of the American economy because they're far less likely to be internationally based companies. They are the kind of companies that you see in shop fronts when you walk down a normal street and things like that. And so they're a better representation of the American economy. And the fact that actually the Russell 2000 underperformed by a massive amount is not a good thing. In the rest of the world then, what was it like? Well, it was mostly the same, sort of okay, but nothing awful, nothing amazing. In Europe, stocks were down, but not by a huge amount. The FTSE 100, they fell by 0.15%. In the rest of the mainland Europe, stocks 600, well, stocks fell by 0.7%. For the world then, the MSCI World Index actually fell by 0.6% for the day. Now, the dollar strengthened as it saw a flight to safety once more. It is still the safest currency out there, so I'm sorry to say that to anyone who wants the dollar to collapse. It isn't collapsing yet. It isn't going to collapse anytime soon. It rose, its spot index rose by another 0.5%. The euro fell by 0.7% down to $1.04. The pound fell by 0.5% to $1.21. And the yen fell by about 0.3% to 137 yen per dollar. In the world of bonds then, in fixed income assets, yields fell across the board. The US 10-year Treasury yield fell by 8 basis points to 3.09%. The German 10-year yield fell by 11 basis points. The British 10-year yield fell by 8 basis points. And really, this is how we would traditionally expect the bond market to react to problems in the stock market. Bonds would see a flight to safety. They would see people move into bonds, prices would rise, and yields would fall. Finally then, what happened with commodities? Well, oil prices fell about 2% for the day, a decent amount, but nothing really too surprising these days. WTI crude oil is at $109 a barrel. Brent crude is at $113. So a touch lower than it was yesterday or the day before, but really no major change there. Gold prices fell very slightly too, and they're currently at $1,815 an ounce. Now, why did we see markets respond like this? Well, firstly, we are nearing the end of the first half of this year, so there's a lot of rebalancing of portfolios going on. And if you have a look at how stocks performed by hour yesterday, you'll see that actually they were very volatile, even if by the end of the day, they mostly closed where they opened. Now, Powell said a few things, as did a few other central bankers, and there will be a full video coming out on this later. In short, Powell said that the economy is in strong shape, that it's well positioned to withstand tighter monetary policy. He also said, though, that a soft landing is not guaranteed, and he basically said that he still wants to bring inflation down, even if it causes pain on the American economy. Now, markets and investors aren't really sure how to price this information. On the one hand, rate hikes should be bad for markets. They make it difficult to raise capital. They make it difficult to finance growth. And so that should bring forward PEs down because forward earnings will be falling. And so company valuations should fall. On the other hand, though, we have this weird idea that actually rate hikes are good for the economy and good for the market because they'll bring inflation down. And so in the long run, they'll end up benefiting us. And the markets aren't really sure which narrative to go with. Investors aren't sure which one they should be trading based on. From my point of view, I think we need to wait to see how effective these rate hikes are at curbing inflation, how quickly inflation is going to be falling, because as of yet, it's still rising and the rate hikes have been coming for a few months now. So I don't think it's fair to say that actually rate hikes are good or bad for markets yet. We just need to wait and see how effective they are at actually curbing inflation, and then we can say for certainty whether or not they're good for markets. Now, in the world of cryptocurrency, well, it was another tough day, to be honest. Bitcoin fell below the $20,000 mark and is touching $19,000, as you can see, down about 4%. Ethereum, ETH did quite a bit worse and is closer to $1,000, down 7% for the day. Most altcoins were down more than that, maybe 10% on average for the day. Really nothing too special, nothing to write home about, but altcoins underperforming the bigger boy of Bitcoin for the most part. Now, why did crypto in particular do quite poorly? Well, there is a bit of bad news. Three Arrows Capital, who we spoke about over the last couple of weeks, they're a massive crypto investing fund. In reality, what they were was a company that borrowed hundreds of millions, billions of dollars, and then they bet on leveraged bets that crypto would go up forever. And when crypto stopped going up, well, they suddenly found themselves without money. That organization, 3AC, has just been officially ordered by a court to liquidate their holdings and to pay out as much as they can to their debtors. What we're seeing here is that billions of dollars has been lost, firstly, by 3AC. That company is basically dead. It's no longer really an investment firm, but also they had billions of dollars in loans from companies like Genesis, BlockFi, and Voyager. Quite a lot of crypto exchanges and companies like that. And so each of those companies are going to lose hundreds of millions each, as these loans that they gave out are going to be unpaid. Now, this is bad for the crypto market as a whole for the same reason that it was bad when Celsius basically went kaput, because actually these companies are going to lose money. They might struggle to pay out the assets that they've been gambling on as well. More people might find their cryptocurrency being stolen by the company that they chose to loan it to. Basically, this is bad for the crypto market. It's bad for investors in particular. And there isn't really a simple way out here because the money is pretty much gone. Now, in other crypto news, we last week spoke about the Harmony Heist, where basically this bridge protocol on the Ethereum network was hacked for about $100 million. And at the time, we weren't really sure who did it, but we do now think it is this infamous North Korean hacker group called Lazarus. Basically, they've been laundering their stolen money in the same way that Lazarus have done so in the past. I just thought this was quite interesting to have what is not even a state-sponsored hacking group, but actually a state hacking group itself. It isn't even like this group is allowed to act with impunity from within the borders of North Korea. They're actively sent out by the North Korean government to bring in some money for the state. That's pretty crazy in my opinion. It's quite interesting that this is the point that we've got to regarding cryptocurrency. That being said though, this news isn't really anything to do with the crypto market crashing. I doubt anyone really cares that it was Lazarus who stole this money. It doesn't really make a difference who stole the money. The money's gone. It's being laundered away. And so no, this isn't actually impactful for the markets itself. Just a little interesting story I thought was a little bit odd. We then got some news from the Bank of England and the central bankers from my country. We heard from them and they said a few things. One of the big things they said was that the UK has the option to act far more forcefully to stop inflation with larger rate hikes and things like that. And so I asked them, why haven't you done that? Inflation is already at 9%. This is too little, too late. They also came out and said that they're expecting to do more 25 basis point rate hikes throughout the rest of the year and maybe one 50 basis point rate hike. Frankly, I think that's really quite dovish and a little bit unexpected considering how at the beginning of the year, they were at the front of the pack. They were the most hawkish central bank. They were the ones that cared most about inflation and about curbing it. And now they're not quite the bad one. The European Central Bank is still far, far worse, but they're not exactly on good standings. They're not exactly doing their job. They've also said things like they are monitoring the usual things that central banks monitor, like pay increases, wages increases. And that sounds bad, but actually inflationary wage increases are really bad for the economy right now. And that will just feed into higher cost inputs for products and so higher prices in the long run. When you have really high inflation like this, it is okay to see salaries rise. But if you want to bring inflation down, that really has to be based on increased productivity in people actually doing more for their money rather than just wages keeping up with inflation, which just feeds into inflation into the future. Now, why is the Bank of England not acting on this stronger inflation data that we've been getting out? Well, basically, lots of the inflation in the UK is based on the energy price shocks that we've seen recently, particularly with the war in Ukraine. And the Bank of England is sort of hoping that, firstly, they can't impact those price shocks, and so that it's not really their job. And they're secondly hoping that actually prices in the energy market will just fall on their own, really, without saying the word transitory, because no one can say the word transitory without losing all credibility anymore. They're hoping that this inflation is transitory and that it will fall on its own. Now, I understand their point of view, but I certainly don't approve of it. I say hike those rates, destroy inflation, and get this problem finally sorted. Now, in a little bit of corporate news to finish off the day, we saw Shopify's share price fall by 90% in one day, except it didn't fall by 90% in one day because it had a 10-to-1 stock split, so that's entirely irrelevant. Now, the argument here, as you'll see from this awful site, The Motley Fool, is that actually it's now easier to buy Shopify stock. Each stock has a little bit lower of a barrier to entry, so maybe more investors will come along, and maybe that will cause Shopify's price to rise. This is a really outdated way of thinking of things because, frankly, the vast majority of investors these days have access to fractional shares. And so this effect of a stock split leading to a price hike just doesn't really have much basis in reality. Please don't buy Shopify because of this stock split. Make a decision based on the company itself, on its data, on its projections, whether or not you want to buy the stock, whether or not you want to own a part of that company. Personally, I'm obviously not buying Shopify shares, frankly, because the recession will crush Shopify stores. People who sell, let's be honest, useless crap online to people and they advertise through Instagram ads or TikTok ads. Well, the reality is that actually that kind of expenditure is going to be the first thing to go out of people's budgets when a recession comes and people start losing their jobs. Shopify is going to lose an awful lot of revenue because of that. They're not even profitable as they are, and they're still at a very lofty valuation. I think they make about $1.2 billion of revenue a quarter, about $5 billion over the course of a year, and they're valued at about $40 billion. Again, while being unprofitable, that's a pretty lofty valuation. Finally, for the day, we just have this very quick story here about the Jupiter Fund, which is this asset management fund that has $68 billion worth of assets under management. The CEO has just announced that he's going to quit and do nothing but sit on a beach all day. Now, he's about 51 years old, so he's not super young, but he's super old either. That's not really retirement age, to be honest. And this is quite rare to see. People in this sort of position, they're usually incredibly well driven to get to that point in the first place. And so they usually never really retire either. Look at people like Ray Dalio, Charlie Munger, Warren Buffett. They work long into their elder years and they never really stop. Honestly, I think it's quite nice to see someone take the opposite route. This guy's obviously got more than enough money. He's fantastically wealthy. And so he's deciding that he just wants to sit on a beach and do nothing and spend time with his family. And I thought that was just a nice little story to end off on today. If you enjoyed this video, then make sure to like, comment, and subscribe to bless the YouTube algorithm. It really does help. If you want to join our exclusive community, then check out our Patreon. You get access to our Discord server and extra content like access to my portfolio and buy and sell alerts for all my own investments. Also, make sure to check out the link in the description to Masterworks. It can help you protect your portfolio against market turmoil through fractional shares of art from world-famous artists. Art has historically proven to be uncorrelated to the markets, so it's a really valuable resource with the markets falling every week. There's also a link in the description to I Trust Capital, which helps you to invest in crypto through your tax-advantaged IRA, which could literally save you thousands. If you, like me, think crypto going down is a buy-in opportunity, then now is the perfect time to join I Trust Capital. Thank you all for watching. Stay stoic. Until next time.